1. Investment and savings. Segregated funds and annuities are investment and savings products marketed to individual and group prospects and clients. Segregated funds are exclusive to the life insurance industry. Only licensed life agents can represent segregated funds. Some annuities are also exclusive to the life insurance industry. Others are sold both by licensed life agents and by other financial institutions, such as banks. Segregated funds and annuities provide guarantees to investors. They can help some investors reach their financial objectives, such as retirement. Many options are available for those who save and have the desire to invest those savings. Every option has features suitable for some investors, but not others. The life agent has a duty to clients to identify which investment is in their best interest, to represent information fairly, and to know the limits on the advice he is authorized to give. 1.1 Investment and Saving Principles. There are certain time-honored principles that apply to investing and saving. It is essential to understand these basics, which are the foundation of all investing and saving, before focusing on segregated funds and annuities in particular. 1.1.1 Concept of investing. Investing can only begin when an individual has savings in the bank or has the ability to set money aside from income that can be earmarked for savings. You may find that some coaching is required to get your client on the path to saving, so that investing can begin and wealth is accumulated. How can saving be simplified and encouraged? There are some old standby methods that have stood the test of time. They include: pay yourself first, make savings an item on the budget, just like any other expense. This reduces the temptation to spend. For instance, a pre-authorized contribution, PAC, or pre-authorized deposit, PAD, to a savings or investment account is a highly effective way to build savings. Save 10% of take-home pay, exactly as its name says, but the percentage may need adjustment according to individual circumstances. Save exceptional payments, save money received from an income tax refund or a work bonus. Set up savings buckets. A savings bucket has a dedicated purpose. It is rewarding to see savings goals for specific objectives being reached and can reinforce savings habits. Buckets could include retirement, holidays, or big-ticket items such as a car. Budgeting. Budgeting is crucial for managing day-to-day finances and allocating a sum for saving. When savings have accumulated or can be earmarked, then it is time to start considering how to grow that money through investing. Investing is the process of using savings to purchase investment products with the goal of making money. A business invests money in new equipment, for instance, that will help it make more products faster or cheaper. The business profits from its investment. The goal of individual investors is to invest a sum, called principal or capital, in an investment product that will be repaid to the investor plus a profit. That profit is called the return. Many investment products are available for individual investors. Some investments guarantee that the full amount invested will be repaid plus a profit. These investments include guaranteed investment certificates, GICs, and some bonds. Other investments do not guarantee that the amount invested will be repaid. These non-guaranteed investments include stocks, mutual funds, and real estate. Where do segregated funds and annuities stand in respect to such guarantees? This chapter and this manual describe how these insurance investments provide guarantees, to whom, and when. 1.1.2 Investment Basics. Some investment basics are fundamental to understanding how investing works, how returns are generated for investors, and how investors manage risk. 1.1.2.1 Compounding. Compound interest. Compounding is a concept that is basic to investing. It is a very powerful investing tool. Interest on an investment may be paid daily, monthly, quarterly, or annually. The investment may permit withdrawal of the interest or for the interest to be added to the value of the investment. When it is added, or reinvested, the value of the investment grows. At the time of the next interest payment, interest is calculated and paid on the total investment value. That value is a sum of principal plus interest previously paid. As a result, the investor earns interest on interest. This form of interest is called compound interest. It achieves escalated investment growth as Table 1.1 shows. Table 1.1 Investment growth escalated by compound interest. Year interest is received on 1 principal 2 principal plus interest earned in year 1 3 principal plus interest earned in years 1 and 2 4 principal plus interest earned in years 1, 2, and 3 5 principal plus interest earned in years 1, 2, 3, and 4, etc., until the investment matures, or the investor ends the investment. Compounding is especially effective when it is applied over a long period of time. Diagram 1.1 shows how the compounding effect accelerates. Time is money's best friend. That is why advisors recommend that individuals start saving as early in life as possible so that the benefits of compounding can be realized to their full potential. Diagram 1.1 Growth of invested money over time. In order for compounding to work to its maximum potential, all investment returns must be reinvested. Withdrawals diminish or eliminate compounding. Unfortunately, compounding also has a negative side since costs can also compound. Debt, in which an outstanding unpaid balance is charged interest, also compounds. 1.1.2.2 Investment returns. All investments have one of three types of return. Returns can be positive and reflect a profit earned from the investment. Returns can be neutral, in which the investor receives the sum initially invested plus any fees paid. He is back where he started. Returns can also be negative. In this case, the investor will not receive back all the money invested. This is a risk of investing. The return is often expressed as a percentage of the amount invested. In those cases, it is called rate of return. It can be a positive number, such as 10%, or a negative number, such as minus 10%. In some cases, investors may be informed of the expected rate of return on an investment before they invest. In others, it is impossible to tell investors what to expect because the return cannot be accurately predicted. This is a characteristic of a risky investment. There is also a scale of risk expressed for investments, which is a guide to the investor about how likely it is that he will receive all his money back. The scale of risk plots the amount of risk an investor takes on in a range between the bottom of the scale, which is very low risk, and the top of the scale, which is extreme, called speculative risk. An investor with a very low-risk investment can be very confident that he will receive back all his invested money. Speculative investments are the most risky. An investor who makes a speculative investment knows that he may not get back all the money he has invested. There is a very high degree of risk that he will experience a negative return and lose money. However, there is also a possibility of very high returns and earning a significant profit. Moderate or balanced risk investments are in between the two ends of the risk spectrum. Why would an investor consider risky investments? Risky investments provide the opportunity for far greater positive returns than those with lower risk. This concept underlies investment risk/return theory. It is based on rewarding those who are prepared to risk their money with a better return. Investors who are not willing to risk the loss of their money receive a lower rate of return. Returns are classified as nominal returns or real returns. A nominal return is the stated or advertised rate. For example, a savings account is advertised with a 2% return. That is its nominal return. Real return is calculated as the nominal return on an investment minus the rate of inflation. Asset classes are categories assigned to investments that have similar characteristics and are governed by similar laws and regulations. The three main asset classes are stocks, also called equities, bonds, also called fixed income or debt, and cash, also called money market instruments. Two other classes are often added. They are real estate and commodities. Each type of asset class has its own risk and return features. Asset classes are fundamental to the investment concept of diversification. 1.1.2.4 Diversification. Diversification is a strategy used in investment portfolios and pooled investments. It combines asset classes and investments within those classes to spread out investing risk. Therefore, diversification in a portfolio lessens risk, based on the well-known theory of not putting all your eggs in one basket. Diversification can be accomplished in many ways. It could be through buying stocks of a wide range of industries or companies, or bonds with varying interest rates. Another form of diversification uses foreign investments to take advantage of different economic conditions in other countries. This spreads risk over national and foreign investments and their respective economic conditions. When an investor buys into a pooled investment, like a segregated fund, he automatically receives the benefit of diversification. Each segregated fund is invested in a wide range of investments specific to its type. For instance, a bond fund is diversified across a broad spectrum of bonds in its portfolio that mature at different times, have varying degrees of risk, and make payments at different interest rates. Other investments that offer similar diversification include mutual funds and exchange-traded funds, ETFs. When an investor buys one stock or bond, or 10, or even 100, he is not receiving the full benefit of diversification. 1. Risk is centered on performance of those individual investments. If they lose value, there are not sufficient offsetting investments to compensate for losses. Therefore, it is very difficult for an individual investor to achieve diversification unless he invests in a fund-type investment. Most investors simply do not have enough investment capital to be able to achieve adequate diversification in a portfolio of their own stocks and bonds. Those that do often rely on investment professionals for frequent advice. 1.1.2.5 Liquidity. Liquidity describes the ability to cash in, or sell, an investment quickly at or near its current market price. An investment that has characteristics of liquidity is called a liquid investment. A savings account is a liquid investment because some or all of its value can be quickly accessed for use. An investment that does not have characteristics of liquidity is called illiquid. Real estate is often cited as an example of an illiquid investment since considerable time could elapse between the sale of a property and receiving its proceeds. Liquidity is essential in an investment when a part or all of its value will be used to provide an emergency fund to an investor. An emergency fund is a portion of earnings set aside for emergency purposes, such as when there is a sudden need for income due to an unexpected job loss. When such a need arises, the investor must be able to quickly and easily sell his investment and obtain its highest market value. 1.1.3 Time value of money. The present value of money is one aspect of the principle known as the time value of money. The future value of money is the other. It is very important to understand the differences between the two. Both principles are based on the potential for invested money to increase in value over time due to interest being earned. They do not consider investment growth due to other factors, such as capital gains. 1.1.3.1 Present value. Understanding present value, PV, and being able to calculate a present value sum is essential to many financial planning activities. Present value works backwards from a future date. It answers the question of how much is needed now to achieve a future savings goal. Therefore, it would be used to help a person determine how much needs to be saved today to yield specified retirement savings at a future date. Likewise, a parent who must meet future post-secondary education costs for a child could be provided with that information from a present value calculation. Present value tells us that if $5,000 is needed at a future date, then less than $5,000 needs to be saved today because today's sum will earn interest and grow over time. The present value calculation is performed when the future sum is known, the future date is known when the sum is needed, and when the interest rate between today and the future date can be specified. Present value is generally calculated using a calculator, through an online resource, or with software provided by insurers. It applies to both a sum of money and cash flows. The formula for the calculation is PV equals FV divided by 1 plus interest rate, N. FV is the known future value and N is the number of periods for the calculation. Years time. 1.1.3.2 Future value. The future value, FV, calculation answers the question of how much a sum invested today will be worth in the future. Therefore, if a future retiree has a certain amount saved for retirement purposes now, he can determine how much that amount will be worth at retirement in 10 years using a future value calculation. The calculation is performed when today's amount of investment is known, the future date is known, and the interest rate between today and the future date can be specified. Like present value, future value is generally calculated using a calculator, through an online resource, or software provided by insurers. The formula for the calculation is FV equals PV times 1 plus interest rate, N. PV is today's known sum, present value, and N is the number of periods for the calculation. 1.2 Investment Objectives. Investors have many reasons for investing and saving. Their reasons are called their investment objectives. It is important for investors to articulate their objectives since the purpose of investing and any time constraints will be the basis for many investment decisions. Investment objectives can be classified as short-term, medium-term, or long-term. A short-term objective is a goal to be reached in 3 years or less. Medium-term is the period between 3 and 10 years, and long-term objectives are 10 years or more. An example of a short-term objective would be saving for a holiday next year. Medium-term objectives could include saving for a new car or for the down payment on a home in 5 years. One of the most common long-term objectives is saving for retirement, which might be many years in the future. Investment objectives for individual clients are very different from those for groups, such as a group of employees covered by a pension plan. While the individual focuses on his specific needs, a group plan focuses on the needs of the group administrator, which is usually the employer. Its goal is often to offer an employee benefit by providing a retirement pension to their group. By providing a plan that helps to attract and retain quality employees, the plan serves the goal of the employer. Knowing the client is the key to understanding his investment objectives. 1.2.1 Account Purpose. Many forms of accounts are available to meet investment objectives. It is important to align the proper account with the appropriate investment objective. Here are some forms of accounts available and their purpose. Registered Retirement Savings Plan, RRSP Retirement. Registered Education Savings Plan, RES Post-Secondary Education Costs, usually for a child or grandchild. Registered Disability Savings Plan, RDSP Income for a disabled dependent. Tax-Free Savings Account, TFSA Tax-Free Investment Growth. Registered Pension Plan, RPP Retirement Savings for members of a group. These accounts are all examples of registered accounts. Registered accounts are individually registered in the account owner's name with the Canada Revenue Agency, CRA, to provide tax benefits. Non-registered accounts are also available for savings and investing. They have flexibility for deposits and withdrawals, unlike registered accounts. Although not registered with CRA, returns must be reported to CRA for tax purposes. It is important to recognize that the account itself, whether registered or not, is simply like a shopping bag. The bag is empty until savings go into the bag, and those savings are invested. Investors typically shop around for the best investments for their savings. Their investment choices determine account performance. Therefore, a person cannot be dissatisfied with owning an RRSP, for instance, since the RRSP is simply the account type. He can be dissatisfied with the types of investments he has selected within the RRSP because they are not performing adequately to meet his retirement objective. Those investments can be removed from the account and replaced with others to achieve the account performance that will satisfy his investment goals. 1.2.2 Financial Goals. A financial goal is a dollar figure associated with an investment objective. For example, an investment objective is retirement at age 60. The financial goal is to have $800,000 saved in an RRSP at age 60 so that retirement can begin. Segregated Funds and Annuities Chapter 1, Investment and Savings 10. Financial goals are a target that investors can work towards. They are a powerful motivator to begin saving and investing, continue saving and investing, and monitor investment performance. 1.2.3 Need for Guaranteed Investments. A guaranteed investment is an investment that makes a guarantee to its investors. The guarantee may be to pay back some or all of the money invested at a future date. That guarantee might be enhanced by also guaranteeing that a specified return will also be paid to the investor. Guaranteed investments are safe investments. They have less risk than investments that do not provide a guarantee. They appeal to investors who are not risk takers. For the most part, their returns are lower than investments that are not guaranteed. Guaranteed investments offer investors great peace of mind. Investors know the minimum amount they will receive and when they will receive it. With some guaranteed investments, such as annuities, there is no need to monitor investment performance or be concerned about ups and downs in the stock market. Investors who have predetermined obligations, such as the need to pay university tuition for a child at a set date in the future, can rely, for example, on guaranteed investments to meet their obligations. Finally, guaranteed investments are often the preferred investment choice for those whose ability to earn an income from working is restricted. This is often because these individuals are either nearing retirement or have already retired. They do not have the capacity to recover from losses on investments where the principal may not be repaid. They need their principal returned because they are no longer able to regenerate that sum through employment. 1.2.4 Time Horizon. A time horizon is a future event when invested money will be needed to meet financial objectives. For example, the time horizon for someone saving for retirement is the date of retirement. Time horizons are unique to each individual and objective. It is possible for an investor to have many different time horizons based on different objectives. He may have a time horizon for buying a new car, buying a second home, starting a business, paying for post-secondary education, and retiring. As a result, he may have a different time horizon for each saving or investing account. In general, those who have a long time horizon have the ability to invest more aggressively, or with more risk, because they have more time to make up for investment losses that may be incurred as a result of assuming higher risk. The time horizon is closely related to the concept of the time value of money, both present value and future value. Calculating such values provides answers about how much is needed for investment now to meet the stated time horizon or how much will be available at the stated time horizon. 1.2.5 Tax-advantaged investing. For tax purposes, investment returns are classified as interest, dividends, or capital gains. Each form of return is taxed differently. It is important to know that even though taxation varies, returns are usually the objective of investing. Even though interest is taxed at the highest rate, an investor does not want to avoid receiving interest due to the tax he will pay. Interest is taxed at the same rate as income earned from working. There are no tax advantages to receiving interest. Foreign income, including foreign dividends, is taxed as interest. The marginal tax rate of the investor applies to interest income. Dividends are paid quarterly by companies from their earnings to their stock owners. Not all companies pay dividends, and there is no guarantee that a dividend will be paid. Investors with stock in qualifying Canadian companies who receive dividends may benefit from the dividend tax credit. As a result of the tax credit, which reduces tax, the dividends are taxed at a lower rate than interest. The investor's marginal tax rate is applied to the balance after the credit has been applied. Capital gains result when the sale of capital property, such as stocks, is higher than its adjusted cost base, which is primarily the cost of purchase. Capital gains tax is the lowest rate of investment taxation. Only 50% of the capital gain is taxed at the investor's marginal tax rate. Another tax advantage for investments that earn capital gains is capital losses. If an investor loses money on an investment, he incurs a capital loss. Although a capital loss means an investor has lost money on his investment, half the capital loss can be deducted from taxable capital gains on other investments. The loss must be used first against capital gains in the year the loss is incurred. However, if capital gains are unavailable or insufficient in that year, the capital loss may be applied against capital gains in any of the 3 previous years, or in any future year. This reduces the amount of taxable capital gain and the tax to be paid on that gain. The lowest risk investments tend to pay interest. Those that generate capital gains are the riskiest. Therefore, the investor who chooses the riskiest investments can benefit from the opportunity to earn a higher rate of return and from the tax advantages of these investments. 1.3 Types of investments. A life agent license allows sales of segregated fund and annuity investments. These are just 2 possible types of investment in the total universe of investments. Investors may be satisfied learning only about these investments. However, it is far more likely they want to compare many investments to identify the investment most suitable for their objectives and risk tolerance. For instance, an investor may want to compare segregated funds with mutual funds. Therefore, it is necessary for the agent to understand other investments. This allows the agent to make useful and accurate comparisons of investments to best serve client needs. Having an understanding of other types of investments also allows the agent to better understand segregated funds. For instance, an agent who understands stocks and stock market behavior can better explain equity segregated funds to investors. 1.3.1 Segregated funds. The legal term for a segregated fund is an individual variable insurance contract or IVIC. This term is rarely used, and segregated funds are most often simply called segregated or seg funds. Segregated funds are created and sold by life insurance companies. However, not all life insurers offer segregated funds. Those that do go through a process to develop a fund and get the necessary approvals from regulators for the fund. Once all approvals are in place, the fund is open for investment. The date when the fund begins operations is its inception date. Insurers keep their segregated funds separate from other company assets, which is why the funds are called segregated. Insurers manage their segregated funds on an ongoing basis and provide relevant information to potential and existing investors. They are required by law to set aside financial reserves so they can meet their contractual obligations for maturity and death benefit guarantees. People buy segregated funds to benefit from the guarantees they offer for return of capital. This makes segregated funds less risky than mutual funds. Segregated funds are also highly valued because, in the event of the death of the policy owner, the proceeds bypass probate. Probate fees are charged in all provinces except Quebec on assets of a deceased. They can pose a significant charge to an estate. Money is pooled in the fund from the deposits of policy owners. Deposits are made by individuals and groups. Those deposits are invested by the segregated fund manager according to the type of fund that has been created. For instance, the money invested in a bond fund is used by its manager to invest primarily in bonds. Insurers offer many types of segregated funds to match up with the investment objectives of individual investors. Segregated funds are available as investment options for non-registered accounts and registered accounts, such as an RRSP. 1.3.1.1 Advantages and disadvantages of segregated funds. Segregated funds offer some unique advantages compared to other forms of investment. They also have many features in common with other fund-type investments. This overview is an introduction to the reasons people buy segregated funds. It also introduces some of the disadvantages to be taken into consideration regarding segregated funds. Details on these advantages and disadvantages appear in the following chapters of this manual. Unique advantages of segregated funds: black small square maturity and death benefit guarantees, black small square ability to reset provided in some contracts, black small square possible creditor protection, black small square right to designate a beneficiary and bypass probate, black small square tax benefit received when capital losses are incurred, black small square investor protection provided by assurees. Some advantages segregated funds share with other fund investments: black small square wide variety of funds available, black small square ease of investment, black small square vast amount of information available on funds, both before and after purchase, black small square diversification provided, black small square professional management provided by the fund manager, black small square liquidity, black small square ease of switching from one fund to another, black small square ease of redemption, making a withdrawal or surrender of the contract, black small square ability to create an income stream from account value, black small square available for registered, such as RRSP, and non-registered accounts. Some unique disadvantages of segregated funds that are not shared by other fund investments: black small square minimum 10-year term to maturity for the maturity guarantee to apply, black small square often higher fees charged to investors than mutual funds, in the form of the management expense ratio, MER, black small square possible age restrictions on deposits. Some disadvantages segregated funds share with other fund investments: black small square too many choices of funds and often little differentiation between choices, black small square sales charges, and ongoing fees charged as the MER. 1.3.1.2 Where and how to buy segregated funds. Segregated funds are sold primarily by life insurance agents and brokers. Some segregated funds are also sold by investment dealers, but those dealers act as agents of the life insurers. The investment dealers are only a sales channel. Investors must be knowledgeable about their segregated fund investment. To ensure they have all necessary details, the agent provides an information folder before or at the time of purchase. The information folder describes the key benefits of the contract. It also provides information about the fund itself, such as fees the investor pays and past performance. When the investor is prepared to make the segregated fund investment, he will complete an application, usually with the agent's assistance. The application is taken by the agent and sent to the insurer. The insurer prepares the segregated fund contract. That contract is a legal document that describes all the terms of agreement between the investor and insurer. It is finalized when the contract is signed and the investor has made a deposit to the account. The contract is an insurance policy, and the investor is the policy owner. 1.3.1.3 Types of segregated funds. Many types of segregated funds are offered. They may be specialized by asset class to include only stocks, or only bonds, or only money market instruments. They also may be based only on real estate, or only on commodities. They may be specialized geographically, for instance to invest only in equities of a specific country, such as Canada, or region, such as North America. Instead of investing in a single asset class, funds may combine asset classes, such as stocks and bonds. Such funds are often called balanced funds. Balanced funds may represent investment in a single country or across regions. Some segregated funds invest in other segregated funds. These are called funds of funds. Other subcategories of funds are also available, but they are based on the main asset classes. A dividend fund, for instance, is based on stocks since dividends can result from owning stocks. Funds offered by different insurers may have very similar names but be quite different. The Canadian Equity Fund offered by XYZ Insurance Company will not be the same as the Canadian Equity Fund offered by ABC Insurance Company. Each fund holds stocks of companies and the companies may vary fund to fund. Even when the same companies are held in each fund, the percentage of the fund invested in those companies will not be the same. The availability of so many types of funds allows investors to choose from among levels of risk and rates of return. Some funds are riskier than others. Some funds have a higher rate of return than others. Each is designed with specific investor objectives and risk tolerance in mind. 1.3.1.4 Returns and Guarantees of Segregated Funds. The return the segregated fund investor receives as a result of fund performance increases or decreases in the value of investments in the fund minus fees. The return is reported after fees. If a fund earns 7% and fees are 3%, 4% is the investor's return. The return is stated as a percentage and it can be a positive number, such as 5%, which shows a profit has been created, or a negative number, such as minus 5%, which shows a loss in the value of the investment. The investor is able to monitor returns for the most recent month, 3 months, year to date, 1 year, 2 years, 3 years, 5 years, 10 years, and since the fund's inception. It is a well-known truth of investing that past results do not indicate future performance. In other words, an investor is only certain of one thing: what has happened. He can never rely on past returns to predict future returns. Investors are able to limit negative returns from their segregated fund investments due to the maturity guarantee and death benefit guarantee. The maturity guarantee states that when the contract matures, the investor will receive a minimum of 75% of the sum he has invested. This guarantee is a minimum return since the amount the investor receives is the greater of the maturity guarantee or the market value of the fund. There is also a death benefit guarantee provided in segregated fund contracts. If the life insured, called the annuitant, named in the contract dies during the term of the contract, the beneficiary receives a minimum of 75% of the sum invested. If the market value of the contract is higher than the 75% guarantee, the beneficiary receives the market value. Example: Stephen invests $10,000 in a segregated fund with a 75% maturity and death benefit guarantee. He is guaranteed to receive a minimum of $7,500, $10,000 times 75%, at maturity or if he dies. The most he can lose over the total period of the contract is $2,500, $10,000 to $7,500. Therefore, if he has the intention of holding the fund until its maturity, he can choose to invest in more risky funds and try to achieve a higher positive return. However, he also knows the most that can be lost. The returns segregated fund investors receive are earned as interest, dividends, foreign income, and capital gains. Investors do not receive the annual return as cash. All returns are reinvested in the fund on an ongoing basis, as they are earned. An investor may choose to hold his segregated fund investment in a non-registered account, a registered account, or both. Investors with non-registered accounts are allocated the return as it is earned in the fund. For instance, capital gains earned in the fund are reported to the investor as capital gains. The investor also receives capital losses, if they occur. The amount reported to the investor as the return must be included in each year's income tax filing. Investors with registered accounts do not report returns for tax purposes every year. They earn returns the same as those with non-registered accounts, but their returns are reinvested in the contract. However, when the time comes to make a withdrawal from their registered contract, investors will find that the sum they receive is taxed at the same rate as income from interest, regardless of how it was earned. In other words, they do not receive the tax benefits of a capital gain or loss, or the dividend tax credit. This is true for all taxable registered accounts. A tax-free savings account is an exception because it is not a taxable account. 1.3.1.5 Risks of investing in segregated funds. While segregated funds are a relatively lower-risk investment, at contract maturity an investor still risks the loss of up to 25% of his investment, the difference between the amount invested and the minimum maturity guarantee. Prior to contract maturity, an investor can lose up to the sum invested since the maturity guarantee does not apply. The investor must also be prepared for the minimum 10-year term of the investment. The investor may be unable to take advantage of other investment opportunities during those 10 years. 1.3.1.6 Investor Protection. Consumers are protected against insolvency, or bankruptcy, of the insurer that holds their segregated fund contracts through Assuries, a nonprofit organization that protects policyholders if their life insurance company fails. This means that if the insurer itself goes bankrupt, the invested money is protected, up to certain limits, by Assuries. The investor is protected against total loss of his principal. The details of the protection Assuries provides are covered later in this manual. Assuries does not provide protection against market losses. Protection against a loss in the value of an investment is provided by the guarantees of certain investments, like the 75% segregated fund maturity guarantee. Non-guaranteed investments can fall to zero value in the market and there is no recourse for the investor. 1.3.2 Annuities. Some investments return the principal invested, plus any profit as a lump sum, to the investor. An annuity is different in that it produces a stream of payments over a period of time. Annuity payments are a combination of the investor's principal and interest paid by the insurer. For this reason, annuities are considered to be a very reliable source of income. They are highly secure, widely available, and protected by Assuries. An annuity is created through a contract between the annuity provider, usually an insurance company, and an investor. The investor's principal is used to fund the contract. The investor names the person who will receive the income payments. This person is called the annuitant. The annuitant may also be known as the annuitant grantee or payee. It is important to carefully read the definitions of the annuity contract, since the wording of the different parties might be different from one contract to another or from one insurer to another. The amount received by the annuitant is called an annuity payment. The annuity payment is based on an annuity rate offered by the insurer, which is largely the prevailing interest rate at the time the investment is made. However, larger sums of principal invested in an annuity receive a higher annuity payment than lower amounts. The annuity payment is also affected by the age and gender of the annuitant. Annuity rates vary between providers. When the annuity payment at the time of purchase is fixed, that payment will be received for the duration of the annuity. It is guaranteed. If interest rates rise, the annuity payment does not increase. Likewise, if interest rates fall, the annuity payment does not decrease. Several types of annuity do not have fixed annuity rates. Their payments are variable. Each guarantees a minimum payment. One form of variable annuity links to investment performance. Its payment will be the minimum payment plus any additional payment as a result of its investment performance. The other form of variable annuity, called an indexed annuity, links to the rate of inflation and increases payments in step with rising inflation. Therefore, its payment is a minimum payment adjusted for any increase in the inflation rate. People buy annuities because of their dependability. They can count on their regular annuity payment. Annuities also relieve the annuitant from any decisions about their investment after initial choices are made. Investors need not worry that they could mismanage their money and possibly experience losses. In effect, the annuity payment is like a pension payment. 1.3.2.1 Advantages and disadvantages of annuities. Some advantages of annuities have already been introduced. The comprehensive list of advantages includes Black Small Square Steady Income Stream. Black Small Square 2 Variable Forms, a variable annuity for investors who hope to increase payments through stock market increases and an indexed annuity for investors who want to increase payments in step with the rising cost of living. Black Small Square Choice of Payment Frequency, monthly, quarterly, semi-annually, or annually. Black Small Square No Need for Investment Decisions. Black Small Square No Need to Monitor Performance. Black Small Square No Worry about outliving one's money when a life annuity or joint and last survivor annuity is purchased. Black Small Square If the annuity is prescribed, less tax may be due in the early years of payment. Black Small Square Investor Protection of Insurance Annuity Contracts through Assuries. Black Small Square available for registered, such as RRSP, and non-registered accounts. Like all investments, annuities have certain disadvantages. They are: Black Small Square Lack of flexibility. Changes cannot be made to the annuity contract. Black Small Square Interest rate risk. If interest rates rise during the contract continues annuity payments based on the initial, lower annuity rate. Black Small Square Penalties to surrender or withdraw from the contract. Black Small Square Loss of principal for an annuitant with a life annuity if death occurs before all the capital paid to buy the annuity has not been paid out in benefits. Black Small Square The amount of money needed to fund an annuity, often not less than $50,000. Black Small Square If the annuity is non-prescribed, there may be a greater tax liability in the early years of payment. Details on these advantages and disadvantages appear in the following chapters of this manual. 1.3.2.2 Where and how to buy annuities. Life insurance companies sell all forms of annuities. Other financial institutions, such as banks, are restricted to sales of term annuities only. Compared to segregated fund investing, a person buying an annuity has very few choices about the investment. He selects the type of annuity, the amount of funding, a payment schedule, and is offered an annuity rate. The annuity can be held in a non-registered or registered account. 1.3.2.3 Types of annuities. The different types of annuities available are the subject of Chapter 3, where they are reviewed in depth. This overview introduces the generic names for what is available. Insurance companies adapt these generic names for marketing purposes. Annuities are fundamentally available in a form that pays an income, called a payout annuity, or a form used for savings, called an accumulation annuity. Payout annuities are the most common. Payout annuities are available in three forms. Black Small Square Term Annuity, also known as a term certain annuity, lasts a specific period of time, such as 20 years. Black Small Square Life Annuity, lasts for the life of the annuitant. When the annuitant dies, the annuity ends. Black Small Square Joint Annuity, also known as a joint and last survivor annuity, used by couples so that when one spouse dies, the surviving spouse continues to receive an income from the annuity. When the surviving spouse dies, the annuity ends. Segregated Funds and Annuities. Chapter 1, Investment and Savings 20. 1.3.2.4 Returns and Guarantees of Annuities. The annuity payment is guaranteed for the duration of the annuity unless the contract is a variable or indexed annuity. As discussed, these forms of annuity provide a minimum guarantee but may supplement that amount with an additional return. 1.3.2.5 Risks of investing in annuities. Interest rate risk is the primary risk of an annuity investment. If interest rates rise after the contract is finalized, the investor cannot benefit from the higher rate. The investor may also be subject to inflation risk. Inflation is the increase in the Consumer Price Index, CPI, which is a measure of the cost of goods and services. The CPI generally sees prices increase and illustrates how goods and services cost more year after year. The annuitant who does not have an indexed annuity that keeps pace with the rate of inflation finds a sure loss of purchasing power over time. As the cost of living goes up, the annuity payment, which is the same amount over its entire contract, buys less and less. The longer the annuity payment is received, the greater the inflation impact. 1.3.2.6 Investor Protection. Assuries provides protection for annuity owners and annuitants against the insolvency of life insurance companies. All annuity contracts sold by insurers will be Assuries covered. The details of the protection Assuries provides are covered later in this manual. 1.3.3 Stocks. Stocks are also known as shares or equities. An investor who buys stock in a company is buying ownership in that company. He becomes an owner of a share of the company in proportion to his investment, no matter how small. When investors believe that the fortunes of the company will rise, the value of the investment increases. The opposite is also true. Information about stock value is widely available through websites. Investors need to learn as much as they can about a company in which they intend to invest. Stock is issued in two forms: preferred stock, or shares, and common stock, or shares. Preferred stocks must pay a dividend before the dividend payment is made for common stocks. They also do not usually have voting rights, and therefore a preferred stock owner has no say in the management or operation of the company. Common stock owners have voting rights that allow them to express their wishes in regard to the company at the annual general meeting. Agents who earn their securities license can sell stocks, but agents who sell segregated funds will find stocks are part of their equity, balanced, and growth funds. Those stocks may be Canadian or foreign. Understanding stocks leads to a better understanding of these funds. People buy stocks to participate in their growth in value. Example, $1,000 worth of Apple shares bought in June 1997 would be worth $632,000 today, lower rate of taxation, and to receive dividends. Some buy stocks to take advantage of strategies for derivatives, such as options. The growth or upside of owning a stock is unknowably large, as witnessed by the increase in Apple shares. No one could have predicted in 1997 the development and consumer dominance of the iPod, iPhone, iPad, and Mac computers. The loss or downside can be a total loss of invested capital. 1.3.3.1 Advantages and disadvantages of stocks. The main advantage of stock ownership is the ability to benefit from gains in a stock's price. There is no ceiling on how high a stock's price can rise, in theory. Other advantages include small square high degree of transparency in stock market investing. Stock prices are available for anyone to see through the stock market on which the stock is listed, such as the Toronto Stock Exchange. Small square dividends. Each stock owner of record as of a certain date receives the dividend, a dollar or part dollar amount per share, e.g. 50 cents per share, after the dividend has been declared by the company directors. The dividends may benefit the investor by the dividend tax credit. However, many stocks, including those of some of the largest companies, like Amazon, do not pay dividends. Small square opportunity to attend annual meetings of the corporation. Owners of voting shares can vote on matters of concern, such as a change in management or management salaries. Small square favorable tax rates for capital gains and capital losses. Capital gains tax is the lowest rate of taxation to be paid on an investment return. A capital loss reduces a taxable capital gain. Small square available in self-directed registered, such as RRSP, and non-registered accounts. Disadvantages of stock ownership include small square possibility of loss, even total loss, of principal invested. Small square possible absence of diversification in the portfolio that exposes the investor to risk. Small square need to monitor price movement and identify when to buy and sell. Small square not all companies pay dividends and there is no guarantee that dividends will be paid. Small square commissions charged on every trade. Small square liquidity issues if stocks must be sold at a time when the price is depressed but the investor needs money. Small square no naming of a beneficiary on a non-registered account. Small square no creditor proofing. Small square no ability to rescind a sale. 1.3.3.2 Where and how to buy stocks. Stocks are listed on stock exchanges, such as the Toronto Stock Exchange, TSX. Each listed company is traded under its ticker symbol, which is an abbreviation of the company's name, such as BMO for the Bank of Montreal. Investors have a large number of companies from which to choose. In order to buy stocks, an investor needs an account with an investment dealer that provides trading services, advice and recommendations with buying and selling provided on a commission basis, or a discount broker, buying and selling provided on a reduced commission basis. Stock trading is available online in a do-it-yourself approach or through traditional channels, such as an account at a dealer. An application is completed by the investor to satisfy the Know Your Client (KYC) requirement for those who sell stocks. KYC information assures the sales representative that the investment is within the financial capability and risk tolerance of the investor. KYC should be reviewed annually and if there is a material change in the circumstances of the investor, such as retirement. 1.3.3.3 Returns and guarantees of stocks. Returns on stocks are in the form of black small square capital gains, when stocks are sold at a profit. Black small square dividends, when declared by the board of directors. There is no guarantee that either a capital gain or dividend will be received. Any money invested can be lost. 1.3.3.4 Risks of investing in stocks. Stocks run the spectrum of risk. Blue chip stocks are the stocks of large, well-known, and well-established companies. For example, in Canada, Canadian National Railway is considered a blue chip stock. Blue chip stocks are one of the least risky forms of stock ownership. The most risky are so-called penny stocks. They are stocks valued at less than $5 that are typically illiquid and highly speculative. Penny stocks may include well-known companies, such as Bombardier, in addition to smaller firms that are not household names. An investor in stocks can experience market risk, industry risk, and the risk of loss of principal invested. This loss can be total. Currency risk can diminish returns if an investment is made in foreign currency. Forms of risk are discussed later in this chapter. Derivatives, such as options, exist to help mitigate risk of stock ownership. They are advanced investing strategies and beyond the scope of this manual. 1.3.3.5 Investor protection. Similar to the protection provided by assurees on the life insurance side, investor protection for stock investors is provided by the Canadian Investor Protection Fund, CIPF, in case of investment dealer insolvency. CIPF protects accounts held by its members to specified limits if the dealer becomes insolvent. This does not protect against a decline in the value of the investment, it only covers losses associated with the bankruptcy of a dealer. CIPF member firms are investment dealers that are the members of the Investment Industry Regulatory Organization of Canada, IIROC. It is important to understand that no protection is available for declines in the market price of stocks. If the market price of a stock goes from, say, $100 to $2, investors in that stock have no protection from losses sustained. Their only recourse to try to limit their loss on a declining stock is to sell the stock, if a willing buyer can be found. 1.3.4 Bonds. Stocks are an equity investment. Bonds are a debt investment. This is because bonds represent a debt between a borrower, who is the bond issuer, and a lender, who is the bond investor. Bonds are also called a fixed income security. Many segregated funds focus on bonds or include bonds as part of their portfolio. Therefore, an agent who understands bonds will also have a better understanding of bond funds. Issuers of bonds fall into two broad categories: governments and corporations, both national and international. When an issuer needs money, it issues a bond, which is purchased by investors. The investor, in effect, is lending money to the issuer and the bond is the IOU. The bond market in Canada is huge. In 2020, it was about $1.90 trillion. Bonds are issued with a fixed maturity date. On that date, the borrower, the issuer, repays the full principal amount to the lender, the investor. The period of time between the issue of the bond and its maturity date is called the term to maturity. Bonds are issued with a wide range of terms to maturity, from 1 year to 30 years. An investor can sell a corporate or government bond before its maturity date to another investor, and an active market exists for buying and selling bonds. This is called the secondary bond market. In return for using the investor's funds for the term of the bond, the issuer makes two promises to the investor. First, during the term to maturity period, the issuer will make regular interest payments to the investor. The interest rate is called the coupon rate of the bond and is typically payable twice a year. Second, the issuer will repay the full face value of the bond to the investor at maturity. Bonds that are issued with a high credit rating can preserve and increase capital as well as provide a predictable stream of payments in the form of interest income. A high credit rating indicates a low chance of the issuer defaulting on payments to investors. 1.3.4.1 Advantages and disadvantages of bonds. Bonds are issued by a wide range of domestic and international business and government entities. Therefore, an investor can choose among credit ratings, issuers, terms to maturity, and coupon rates, i.e., interest rates, to build a diversified portfolio of bonds with the aim of delivering higher returns while reducing overall risk. Managers of bond funds follow such a strategy. Repayment of the face amount and interest payments are guaranteed for government bonds issued by many countries because the issuing government has government revenue at its disposal to meet its obligations. Countries such as Canada, the U.S., and the nations of the European Union are able to make such guarantees. On the other hand, countries struggling with political or economic uncertainty may represent a risk of default. This could include countries such as Turkey, Egypt, Brazil, or Argentina. A government that could not meet its bond payments as they became due would experience a total loss of international investor confidence. Corporate bond issuers make a commitment to repay their investors for the same reason. They need investor confidence so they will be successful when they need to borrow more money via bonds in the future. However, there is a greater chance payments will not be made for a corporate bond than government bonds since a corporation's fortunes can change quickly, and a corporate issuer might not have the necessary capital at its disposal to repay investors. Breaking the promise to repay investors is taken very seriously. Corporate bonds run the spectrum of risk, and investors who are prepared to take a higher risk are rewarded with higher interest payments from the bond. Bonds are purchased by more sophisticated investors to balance typically large portfolios. Coupon payments made by bonds can also form a regular income stream. Investors are apprised of their risk by the credit rating given by bond rating agencies. Canadian government bonds are rated amongst other bonds with the highest credit ratings, due to the government's ability to pay interest and repay the principal. There is a lack of transparency in the buying process that puts bond investors at a disadvantage. An investor may not necessarily get the best price, and by overpaying, total return is diminished. Also, terminology used to describe prices and yields of bonds can be confusing to average investors. 1.3.4.2 Where and how to buy bonds. Bonds are available through advisors licensed by IIROC and some members of the Mutual Fund Dealers Association, MFDA, who are licensed as limited market dealers. Many financial advisors do not have direct access to bonds because their licenses do not permit them to offer these types of securities. 1.3.4.3 Types of bonds. Bonds are issued by all levels of government in Canada and by Canadian corporations for investors in Canada to buy. Foreign countries and corporations also issue bonds that may be purchased in Canada. Black small square Canadian government bonds are issued by the federal, provincial, and municipal governments and are typically denominated in Canadian dollars. Federal government bonds are ranked the highest, provincial bonds lower, and municipal bonds lower still. Black small square foreign bonds are issued by foreign countries in Canada, in Canadian dollars. Black small square Eurobonds are issued by a foreign country in its currency for sale in other countries, such as a bond issued by the United States in US dollars for sale in Japan. Government of Canada bonds. The Government of Canada is the largest single issuer of bonds in Canada. It issues bonds in its own name and in the name of federal crown corporations, such as the Farm Credit Canada and the Export Development Corporation. Fully guaranteed by the Government of Canada, the bonds are available for terms from 1 to 30 years, in denominations as low as $5,000. The level of interest is fixed until maturity, and payments are made semi-annually. These bonds can be sold at any time. Provincial bonds. Provincial bonds are issued by the provinces and provincial government agencies. The principal and interest of provincial bonds are guaranteed to be paid when held to maturity. The bonds are also highly liquid and can be easily bought and sold. Municipal bonds. Municipal bonds account for a small percentage of the Canadian bond market. Their ratings vary because their credit quality is dependent on the ability of the municipality to generate tax revenues, among other factors. Like other government bonds, municipal bonds may be sold at market value prior to maturity, and a large secondary market exists for buying and selling such bonds. Corporate bonds. Corporate bonds are issued by companies looking to shore up or expand their operations. The risk associated with a corporate bond is almost totally attributable to the creditworthiness of the company. Foreign bonds. Just as governments and corporations in Canada issue bonds, so too do the governments of other countries and multinational companies. Their creditworthiness is a result of the political and economic stability of the issuer. 1.3.4.4 Returns and guarantees of bonds. A bond issuer pledges to repay the face amount of the bond at maturity and make interim interest payments to the investor. There are many factors that affect the return of a bond. They include black small square interest, coupon, rate, black small square maturity date, black small square credit quality, black small square price. Interest rate. Bonds pay interest that can be fixed, floating, or payable at maturity. A fixed interest rate bond is the most common. It pays interest at a rate that is stated as a percentage of the face value of the bond. This interest is usually paid semi-annually. Most bonds pay interest in this way. Example: a bond with a $1,000 face value, bearing coupons with a 3% rate, would pay $30 in interest a year, $1,000 times 3%, $15 on each of 2 payment dates. Maturity. The maturity date of the bond is the future date on which the face value of the bond is repaid to the investor. Maturity dates are often categorized as short-term, medium-term, and long-term. Black small square short-term bonds mature in 3 years or less, black small square medium-term bonds mature in 3 to 10 years, black small square long-term bonds mature in 10 years or more. A bond does not have to be held to maturity. It can be sold in the secondary bond market at the current price for that bond. The market price for a bond is not the same as its original face value. Typically, investors in long-term bonds are rewarded with a payment of a higher interest rate as compensation for tying up their principal for a longer period. Segregated funds and annuities. Chapter 1, Investment and Savings. 27. Credit quality. Bonds are rated based on the issuer's capacity to meet its financial obligations, whether that issuer is a government or a corporation. The highest rated bonds are called investment-grade bonds. They have an AAA rating. On the other end of the risk spectrum are bonds that are most likely to default on repayment. They are called high-yield bonds because they pay a high rate of interest, but are also known by the name junk bonds because of their low rating, typically BB or lower. The return on investment-grade bonds is much lower than bonds with a higher risk of default because of the correlation between risk and return. Fundamentally, lower-risk investments have a lower rate of return, and higher-risk investments have a higher rate of return. Price. The initial investor pays the face value of the bond. This is called PAR. If interest rates change, so does the market price for the bond. When the price rises above face value on the secondary market, the bond is said to be trading at a premium. When the price falls below face value, the bond is said to be trading at a discount. An investor who sells a bond at a higher price than the one initially paid generates a capital gain. At the contrary, an investor who sells a bond at a lower price than the one initially paid realizes a capital loss. 1.3.4.5 Risks of investing in bonds. Bond investors are exposed to a number of risks. These include interest rate risk, reinvestment risk, inflation risk, credit risk, as discussed, and liquidity risk. Currency risk can affect returns on foreign bonds. These forms of risk are discussed later in this chapter. 1.3.4.6 Investor protection. Investor protection for bond investors is similar to that for investors in stocks through the CIPF. The CIPF protects accounts held by its members to specified limits if the dealer becomes insolvent. There is no protection against loss of value. 1.3.5 Savings accounts. When people think of saving money, often the first thing that comes to mind is a savings account at their bank or credit union. Savings accounts offer convenience and, usually, a very low rate of interest. Some accounts are offered as high interest, and these typically have requirements or restrictions in order to receive the better rate. Interest earned in a savings account is automatically deposited to the account. Some people use savings accounts as an investment due to fear of loss of money in other investments and for its accessibility. There is no waiting for funds, a withdrawal can be made at any time. 1.3.5.1 Advantages and disadvantages of savings accounts. A savings account is a source of immediately available cash, with the benefit of interest on the account balance paid at specified periods of time. An account is easy to open and money can be easily deposited and withdrawn. There is often no minimum amount needed to open an account or keep one open. Some financial institutions apply a fee or penalty to withdrawals on savings accounts, especially a high-interest savings account. This acts as an incentive to save money in the account for investing or other purposes. Savings accounts may be advertised with a relatively higher interest rate to attract customers. This promotional rate may not last long. The interest rate that actually applies to the account should be checked periodically. Savers may find the interest rate on their savings account is less than the rate of inflation. Therefore, the money accumulated in savings accounts is subject to inflation risk when the account is used as a long-term investment. The result is that purchasing power is eroded over time. The interest earned in a savings account is taxed at the highest rate charged to investments. This is a disadvantage compared to other investments that pay dividends or receive a capital gain/loss. However, the savings account is a valuable short-term vehicle in which to build savings in even small increments. Those savings can then be redirected into other investments. 1.3.5.2 Types of savings accounts. There are two basic forms of savings accounts, the traditional savings account and the high-interest savings account. The traditional savings account offers a very low rate of interest but sometimes has lower fees and no restrictions on withdrawals. A high-interest savings account offers higher rates of interest that, in some cases, can rival investments such as guaranteed investment certificates, GICs, or money market funds. In exchange for their higher interest rates, there may be a requirement for contributions or a minimum balance, and withdrawal privileges may be restricted. 1.3.5.3 Returns and guarantees of savings accounts. Returns on savings accounts are in the form of interest. Account owners may receive an annual statement from their financial institution with the total amount of interest earned during the year. This must be reported on the investor's annual tax return. Guarantees are based primarily on the strength of Canada's financial institutions and their ability to immediately cash out an account. 1.3.5.4 Risks of holding savings in a savings account. As mentioned above, holding savings in a savings account exposes the account owner to inflation risk. 1.3.5.5 Investor Protection. The Canada Deposit Insurance Corporation, CDIC, is a federal crown corporation that insures savings accounts at member institutions, such as banks, up to $100,000. 1.3.6 Guaranteed Investment Certificates, GICs. GICs are one of the most popular investing options thanks to how easily they can be bought, absence of fees and their guarantees. People also buy GICs because they are familiar and easily understood. Non-registered GICs can be bought online, further increasing the ease of investing. A GIC is an investment classified as a term deposit. It is based on the investor loaning a sum of money to the institution providing the GIC. The institution guarantees that the investor will receive the principal plus the promised rate of interest at the maturity date of the GIC, except when the GIC is linked to stock market performance. GICs are offered in a variety of terms to maturity. 1.3.6.1 Advantages and disadvantages of GICs. Advantages of GIC investing include black small square guaranteed return of principal and interest as promised, black small square variety of products available to give investors choice, black small square available for as little as $500. This helps young investors or investors just starting out who have not yet amassed a more sizable nest egg for investing. Black small square convenient, easy to understand, and easy to buy. Black small square penalties for early redemption are waived if the investor dies during the term to maturity. Black small square no out-of-pocket fees. Disadvantages include black small square low rates of return. Black small square return is paid as interest income and taxed accordingly. Black small square subject to probate fees on death, unlike their insurance equivalent called accumulation annuities. Black small square interest rate risk. Black small square inflation risk. Black small square significant penalties charged to the investor who needs access to the funds in the GIC prior to its maturity date. Segregated funds and annuities. Chapter 1, Investment and Savings 30. 1.3.6.2 Where and how to buy GICs. GICs can be purchased from financial institutions including black small square banks and trust companies, black small square credit unions, black small square caisses populaires, 3 black small square insurance companies, black small square investment dealers, black small square specialized GIC deposit brokers. An application is completed, supplemented with a proof of deposit. 1.3.6.3 Types of GICs. Different types of GICs have distinctive characteristics. The fixed interest GIC is the GIC that most people think of when GICs are offered. Call these plain vanilla GICs. Features that are added to the plain vanilla product will carry additional costs to the investor, such as a lower interest rate. Fixed interest GICs. The return on a fixed interest GIC is a specific guaranteed interest rate. Interest payment options include simple interest that is paid annually and interest that compounds annually and is paid at maturity. Even if the interest is not paid in any 1 year to the investor, it needs to be declared for income tax purposes. Cashable/redeemable GICs. A cashable or redeemable GIC allows the money deposited to the GIC to be received at a date earlier than the maturity date. However, the cost of this feature is that interest rates are lower than those offered on non-redeemable GICs. Escalating GICs. An escalating GIC increases interest rates on its anniversary date. A variation on this form of GIC allows the investor to cash out some or all of the funds on each anniversary date or a specified number of days thereafter. Variable interest GICs. If general interest rates increase over the term of an investment, so does the interest rate of the GIC. Therefore, interest rate risk is lessened. Market-linked GICs. This form of GIC links a portion of its return to the performance of a specified equity market index, such as the S&P/TSX Composite Index. In most cases, market-linked GICs are not cashable before their maturity date. Returns are capped, and, in some cases, investors receive only a portion of the investment returns generated by the actual performance of the equity markets. Foreign currency GICs. A foreign currency GIC is issued in a foreign currency, such as US dollars, and pays fixed interest. It is purchased by investors who believe the Canadian dollar will fall in value against the currency in which the GIC is issued. Therefore, on maturity of the GIC, the foreign currency received is worth more Canadian dollars. Insurance GICs. The accumulation annuity is also known as an insurance GIC. Available exclusively from insurers, this form of GIC offers benefits based on its issue as an insurance contract. These benefits include bypass of probate and creditor protection. These annuities are discussed in detail later in the manual. 1.3.6.4 Returns and guarantees on GICs. GICs guarantee return of principal and interest at the stated maturity date. Their returns are in the form of interest. 1.3.6.5 Risks of investing in GICs. The GIC investor faces interest rate risk and inflation risk. These risks are described in full later in this chapter. 1.3.6.6 Investor protection. The Canada Deposit Insurance Corporation, CDIC, insures Canadian dollar GICs, held at a CDIC member institution, up to $100,000 in each deposit category. Therefore, up to $100,000 in coverage is provided for a GIC that is separate from coverage for an RRSP, RRIF, TFSA, etc. Insurance GICs, accumulation annuities, are protected by Assuries, the organization that provides investor protection to Canadian life insurance policy owners. Segregated funds and annuities. Chapter 1, Investment and Savings. 32. 1.3.7 Mutual funds. Mutual funds are created on the basis of investors' money being pooled into a fund that is owned and managed by a mutual fund company or financial institution. Segregated funds are created on the same basis but are owned and managed by an insurer. Most banks, credit unions, and mutual fund companies offer conventional mutual funds that are known as open-end funds. A mutual fund may be structured as an open-end fund or a closed-end fund. An open-end mutual fund distributes units in the fund to investors proportional to the amount they have invested. A closed-end mutual fund issues a fixed number of shares. This type of mutual fund will not be covered in this manual. New open-end mutual fund units are continually issued as investors deposit money into the fund, while units are eliminated, redeemed, when investors decide to leave the fund. There are thousands of mutual funds available for investment. The challenge for the investor and his financial advisor is to narrow down the choice to one fund, or perhaps several funds, that will be the most suitable for the investor's investment objectives. People buy mutual funds because they are often sold by advisors in financial institutions as an alternative to GICs that offer greater growth potential. While this may be true, matching one or two mutual funds, of the thousands of funds available, to the needs and limitations of the investor takes knowledge, skill, and patience. The advisor should explore the characteristics of funds to ensure suitability to client needs. The client should understand. Black small square how mutual funds make money. Black small square what makes them go up in value. Black small square the total fees to buy, hold, and sell their funds. Black small square the risks of their investment. Black small square how easily their investment could be redeemed as cash. Agents sell mutual funds when they earn their securities license or mutual funds license. These agents may be called dual licensed. Investors in a mutual fund pay fees to participate in the fund. There are three types of fees. Black small square the management expense ratio, MER, which is expressed as a percentage of the fund's assets. It is an annual fee charged by the fund to cover compensation paid to the professional managers of the fund, to pay trailing commissions to advisors, operating expenses of the fund, and taxes. The managers make the decisions about what to invest in, when to buy and sell holdings within the fund, the allocation and diversification of holdings, and many other factors that affect returns. The MER is deducted from fund performance before the performance is reported to investors. Point 4. As of June 1, 2022, some mutual funder dealers will no longer charge a trailing fee. Black small square the trading expense ratio, TER, which measures the trading costs of the fund. It is also expressed as a percentage of assets. A higher TER is evidence of more frequent buying and selling of holdings by the portfolio manager. It is deducted from fund performance before performance is reported to investors. The TER is also charged annually. Black small square a sales charge, also called a load, that may be applied against the amount of investment at the time units are purchased or redeemed. When applied at the outset of the investment, it is called a front-end load. Alternatively, the load may be applied when units of the fund are sold. It is then referred to as a back-end load or deferred sales charge, DSC. A DSC declines over a period of years until it is eliminated. As of June 1, 2022, all provinces and territories will prohibit fund organizations from charging a DSC on new sales, but redemption schedules for sales prior to the ban will run their course in Ontario. This means clients could face DSCs until 2028 or 2029. Some funds are sold on a low-load basis, in which there is a lower fee charged at redemption. Funds are also available with no loads. A standardized risk classification methodology is used for conventional mutual funds and exchange-traded funds, ETFs. This methodology is based on using standard deviation as the risk indicator to determine a mutual fund's investment risk. The standard deviation equates to one of 5 levels of investment risk: low, low to medium, medium, medium to high, and high. This approach provides consistency across all fund risk assessments and makes it easier for investors to compare the investment risk of different mutual funds. As shown in Table 1.2, the risk levels comprise a scale. The fund facts document received by investors reports where a mutual fund falls on the scale. Table 1.2. 5 levels of fund risk. Mutual funds provide the advantage of a variety of withdrawal plans for the account owner. These are called systematic withdrawal plans. The investor may, of course, redeem his investment as a lump sum whenever he chooses, but may also redeem a specified amount per withdrawal to spread out redemptions over a period of time. Disclosure to clients on fees is required by Client Relationship Management 2, CRM2. CRM2 requires mutual funds to provide additional written communication to clients, an annual report on costs and fees, and an annual report on performance. This disclosure is intended to ensure investors thoroughly and accurately understand their fund investment. Some of the disadvantages of which investors should be aware are: black small square mutual funds are not intended to be a short-term investment, and investors must be prepared to hold units for a long period of time to achieve desired returns. Black small square no protection against losses, like that offered by the guarantees of a segregated fund. Black small square tax complexities arise in non-registered accounts that require investors to monitor fund activity. Black small square the fees, such as MER, can erode returns significantly over time. 1.3.7.2 Where and how to buy mutual funds. Mutual funds are offered for sale through banks, credit unions, caisses populaires, insurance companies, investment dealers, and mutual fund companies. They can also be purchased online with some institutions. There are 2 steps that must be completed prior to purchase. First, a new account application form is completed in which the investor specifies the fund in which he will invest, and Know Your Client (KYC) information is gathered by the sales representative. The KYC information is used by the advisor to align investor characteristics, such as risk tolerance, with the proposed investment. Next, disclosure requirements must be satisfied to ensure that the investor understands the details of the fund he is contemplating purchasing. This requirement is met by the mandatory delivery of the fund facts to the investor, and providing him with an option to request a simplified prospectus of the fund and an annual information form, AIF. Fund facts outlines the potential benefits, risks, and costs of investing in a mutual fund, in language investors can easily understand, at a time that is relevant to their investment decision. They are intended to confirm suitability for the investor, both at the time of purchase and on an ongoing basis. Mutual fund companies are required to prepare and file a fund facts for each class or series of each of their mutual funds and to post the fund facts on their website. They are required to deliver the fund facts to the investor before he buys. A simplified prospectus of a fund is a document that is filed with the appropriate regulator that provides full disclosure of material facts that have, or might have, an impact on the market value of the fund. The AIF supplements the information in the simplified prospectus with information that may be of assistance or interest to some investors. When the purchase is made, the fund units are bought at their market value. When the investment is redeemed, the units are sold at their market value. Money market funds are an exception. They do not have a market value. Instead, their units are redeemed at a fixed value. 1.3.7.3 Types of mutual funds. The types of mutual funds available parallel the types of segregated funds available. The Canadian Investment Fund Standards Committee, CIFSC, categorizes funds into 5 broad asset classes. Black small square cash, including funds in the money market. Black small square fixed income. Black small square equity. Black small square commodity. Black small square other. Funds are further assigned a geographical classification or identified as a developed or emerging market. A detailed description of the fund types is provided in Chapter 2. 1.3.7.4 Returns and guarantees of mutual funds. There are no guarantees for the mutual fund investor. The return for a mutual fund is determined based on its net asset value, NAV, per unit and any distributions made by the fund. The NAV is the total net asset value of the fund divided by the number of outstanding units. Distributions are a combination of earnings generated by securities within the fund and capital gains resulting from buying and selling those securities. Non-registered account owners may receive their distributions in cash or reinvest them in the fund. Least the last 5 years between similar funds. In other words, the results of a bond fund must be compared only with the results of a similar bond fund. However, if the investor is simply motivated to find the best return, he could compare 5-year results between different asset classes. For example, he might compare a bond fund with an equity fund. 1.3.7.5 Risks of investing in mutual funds. There are many risks of mutual fund investing, and some risks are particular to the asset class to which the fund belongs. Cash-based funds face interest rate and inflation risk. Equity-based funds face market risk and industry risk. Fixed income funds face interest rate risk. Currency risk can be experienced by funds in which there is foreign investment. These forms of risk will be described later in this chapter. 1.3.7.6 Investor protection. There are 2 investor protection funds available to mutual fund investors. Both can be accessed in the case of dealer insolvency. They do not cover market losses. The Canadian Investor Protection Fund, CIPF, mentioned earlier, and the Investor Protection Corporation, IPC, of the Mutual Fund Dealers Association, MFDA, that insures MFDA members. MFDA members are firms that distribute Canadian mutual funds. The maximum amount of coverage is $1 million for each general account. There is no protection for market losses. 1.3.8 Exchange-Traded Funds, ETFs. Exchange-Traded Funds, ETFs, are a type of pooled investment fund in which investors receive shares in the type of fund in which they invest. Mutual funds and segregated funds also pool investor deposits but issue units instead of shares. People who buy ETFs may be slightly more sophisticated investors than those who buy GICs or mutual funds because ETFs are bought and sold on a stock exchange, and therefore the investor needs a brokerage account at an online vendor or traditional broker. Investors are motivated by the lower fees of ETFs compared to mutual funds. ETFs are the investment products sold by robo-advisors, such as Wealthsimple. Robo-advisors are online investment advisors who use software to automate many tasks that were traditionally performed by portfolio managers. Clients complete an online questionnaire to specify their goals, time horizon, and risk tolerance. The results of that questionnaire determine the best ETF approach. The software of the firm continually monitors the investor's account and rebalances the account automatically to maintain the correct asset mix. This hands-off approach translates into lower fees for the investor who does not want access to personal assistance. ETFs are available in an indexed form and an actively managed form through traditional investment dealers who act as account managers. They guide investors in their choices. The indexed form mimics the returns of an underlying index, such as a stock market index. Indexes exist for many asset categories, for instance equities on the S&P/TSX Composite Index, bonds, commodities, or real estate in Canada and abroad. The actively managed form sees the manager choosing investments for their contribution to a stated investment objective, such as capital growth. There is typically a cost to ETF investors when they buy and sell their shares. This comes in the form of a sales commission, which is similar to the commission charged when an investor trades stocks. Although some ETFs are available without a commission, firms that offer commission-free ETFs will compensate for the absence of commissions in other ways. They may impose the purchase of a specified number of units or a dollar value per trade or require the investor to assign up to their online investing platform. Like mutual funds, an MER is also charged against ETF shares, however the MER is significantly lower than the MER of mutual funds or segregated funds. Also, like mutual funds, a trading expense ratio, TER, is charged. Active ETFs incur the highest TERs because more trading results in a higher total trading cost. Investors may also be charged a trailer fee by the financial advisor managing the ETF on their behalf. 1.3.8.1 Advantages and disadvantages of ETFs. Some of the advantages of ETFs include black small square diversification, black small square convenience of trading like stocks, black small square high degree of transparency with holdings disclosed daily, black small square lower MER than mutual funds and segregated funds, black small square no sales load, black small square professional management, black small square ability to react rapidly to market developments and speculation on short-term price movements, black small square ability for advanced trading transactions such as limit, stop loss, margin, and short sale. Orders, options, and sector rotation, black small square exposure to commodities provided to small investors. Some of the disadvantages of ETFs include black small square a commission is usually charged on buy and sell orders, black small square low liquidity for ETFs that are not frequently traded or not traded in high volumes, black small square fees include both MER and TER, black small square complexity of the investment. The litmus test for investment suitability is the ability of the investor to describe how his money is invested, how growth is achieved, and the conditions under which his principal and returns are received. If an investor is unable to answer these questions about an ETF, then it may not be suitable for him. 1.3.8.2 Where and how to buy ETFs. ETFs are currently sold by ETF Facts. This document contains all the information the investor needs to base his buying decision on, and provides consistent disclosure about the investment, like Fund Facts does for mutual funds. However, since ETFs are traded on an exchange, additional content addresses trading and pricing characteristics. A prospectus is available to investors upon request. To make an ETF investment, the investor either opens an account with a securities firm, discount broker, robo-advisor, or uses an existing investment account. If a discount broker is used, the applicant must find the correct exchange and stock ticker symbol for the desired ETF. 1.3.8.3 Types of ETFs. ETFs are available to track currencies, industries, commodities, style, such as growth, value, or market capitalization, bonds, dividends, or real estate in Canada and abroad. Still other, more exotic, ETFs are available. For example, inverse ETFs move in opposite direction of an associated exchange index or indexes. Inverse financial sector ETFs, for example, profit when the financial sector declines. Volatility-linked ETFs are bets for or against volatility in the stock market. Index-based ETFs track their target index in one of two ways. A replicate index-based ETF holds every security in the target index because it invests 100% of its assets proportionately in all the securities in the target index. A sample index-based ETF does not hold every security in the target index. Instead, the sponsor chooses a representative sample of securities in the target index in which to invest. Actively managed ETFs do not mirror an underlying index. They have a benchmark index, used as a standard to monitor performance. Managers, however, have the ability to change sector allocations, time trades, or deviate from the index as they see fit. Actively managed ETFs must disclose the identities and weightings of the component securities and other assets held by the ETF each business day on their publicly available websites. This provides a level of transparency unique among fund investments. 1.3.8.4 Returns and guarantees of ETFs. There are no guarantees for ETFs. Investors buy and sell shares at market price, and this price changes throughout the trading day. Valuation occurs daily. The performance of an ETF may not exactly mirror the performance of its underlying index. Sometimes the holdings in the ETF are not exactly the same as its underlying index or in exactly the same proportion. This can account for a difference in return between the actual index and the ETF. Distributions are received by investors in the form they are earned, interest, dividends, or capital gains. Cash distributions are paid monthly, quarterly, semi-annually, or annually. Capital gains are distributed in December. Segregated funds and annuities. Chapter 1, Investment and Savings 40. 1.3.8.5 Risks of investing in ETFs. ETF risk is classified in the same manner as mutual funds, and is expressed as low, low to medium, medium, medium to high, and high. These levels are based on a range of standard deviation, which is a formula measuring returns. It demonstrates that the highest risk is experienced in those funds with the highest standard deviation. ETF risk is a result of the index or industry that the ETF emulates, or where the underlying index is based. Therefore, they have market risk and may have industry risk and currency risk. ETFs may also experience liquidity risk if the fund is not broadly based. ETFs that have narrow categories or are country-specific may be thinly traded. Severe economic conditions could dry up trading for such ETFs. 1.3.8.6 Investor protection. The CIPF protects accounts held by its members up to specified limits if the dealer becomes insolvent. There is no protection against market loss. 1.3.9 Real estate. Real estate for investment purposes is not the principal residence of the investor, or other property used strictly for personal use. It includes residential, commercial, and industrial properties that the investor buys and, in turn, rents or leases to occupants. An investment in real estate offers the investor the opportunity to gain from an increase in the market value of the property, and to earn rental income. Equity can grow rapidly if rental income is applied against an outstanding mortgage. 1.3.9.1 Advantages and disadvantages of real estate. Investing in real estate adds diversification to an investor's portfolio of investments. Real estate offers the following advantages to an investor: black small square potential to earn a steady rental income, black small square potential to earn a capital gain on the sale of the income property and benefit from the tax advantages on capital gains, black small square potential to see an increase in property value due to general real estate market conditions or due to improvements in the property that the investor makes, black small square easily purchased investment, black small square physical asset that can be used as collateral to secure borrowing. The disadvantages of investing in real estate include: need to fund the down payment for the land or property. This can be a significant sum depending on the value of the real estate being purchased. Need of the investor to provide evidence of financial stability and strength. He must be able to prove to the holder of a mortgage on the property that he can personally make mortgage payments if rental income dries up. Commissions charged on real estate sales by sales agents are high and greatly reduce the sale proceeds. Other fees, such as a land transfer tax, may also be charged. Value is subject to market conditions. Just as prices may increase, they may also decrease. Obligations of becoming a landlord. Real estate investor landlords have many legal requirements and obligations to their tenants. Ongoing expenses in the form of property maintenance, property tax, and landlord insurance. The property must be kept up to preserve the investment and to meet obligations to renters. Tax must be paid to local authorities based on the value of the property, and insurance will be required to protect against claims that result from premises liability, fire, smoke, water damage, and vandalism. These expenses must be tracked over the entire period of ownership to reduce the capital gain on the property. Government speculation tax. Jurisdictions have implemented a tax on foreign nationals. 1.3.9.2 Types of investment real estate. Real estate investment properties include residential, commercial, and industrial properties. Residential properties include all forms of homes that people rent or lease in which to live. They include condominiums, apartment buildings, and single or multi-family homes. Commercial properties are those used mainly for service businesses, such as a restaurant or office building. Industrial properties tend to be large buildings and facilities in which manufacturing and related businesses generally operate. Investment real estate also includes the ownership of land. This is property that is undeveloped but expected to be developed at a future date. 1.3.9.3 Returns and guarantees of real estate. There are no guarantees provided to real estate investors. Returns are in the form of rental income, which is taxed like interest income, but certain expenses are allowed to be deducted from gross rental income. A capital gain, or capital loss, may be generated if the property increases in market value, or loses market value, at the time of sale. 1.3.9.4 Risks of investing in real estate. Real estate poses some of the greatest investment liquidity risk. An investor who needs the money invested in real estate must hope that a likely buyer can be quickly and easily found. Otherwise, he has little option but to start reducing the price of the property until the price has dropped to a point at which he will attract a buyer. Market risk can be experienced in the real estate market, specifically if the location of the property declines overall, if buyers lose their appetite for certain types of properties, or if the entire market falls. A real estate investor may experience interest rate risk on the mortgage for the property. If interest rates increase during the term of the mortgage, such as 5 years, the higher interest rate will be charged at the time of renewal. This could mean a higher mortgage cost, which might not be able to be offset by charging higher rent. 1.3.9.5 Investor protection. There is no investor protection for real estate investors. January 3, 10 Canada Premium Bonds, CPBs, and Canada Savings Bonds, CSBs. Canada Premium Bonds, CPBs, and Canada Savings Bonds, CSBs, are two well-known types of savings bonds offered by the Government of Canada to residents. Their sales were discontinued as of November 2017, however there are still many bondholders. All bondholders will receive their guaranteed payments on redemption or maturity. January 3, 11 Cryptocurrency. Cryptocurrency, like Bitcoin, and also called cryptos and altcoins, is used both as a form of payment and for speculative investment. It is a digital currency in which crypto tokens are used by participants to transfer value. Cryptocurrency is bought and sold through online exchanges. It is estimated that over 500 exchanges are available and over 6,700 different cryptocurrencies are traded. Cryptocurrency can also be earned through a process called mining, which requires an enormous amount of computer power and technology. People buy cryptocurrency as a means of buying goods without an audit trail or regulations. Transactions occur instantly and have no fees. They also buy it simply to hold and wait for its value to increase. As of 2021, the total value of all cryptocurrencies was estimated at $2.2 trillion. Bitcoin exceeded $50,000 per unit in 2021, but fractional ownership is possible in amounts as little as $25. Some cryptocurrencies are available for purchase with dollars while others require cryptocurrency. The buyer creates an account on an exchange, transfers real money to buy cryptocurrency, and holds his purchase in an online app called a wallet. Transfers are recorded in a public ledger. Investing in cryptocurrency is extremely risky, prices rise and fall dramatically. Most advisors would conclude that an investor be prepared for complete loss of a cryptocurrency investment. January 3, 12 Group plans. Groups that offer savings and investment plans to their members include employers, associations, and fraternal organizations. Group plans are most often associated with employers. They participate as the subscriber or administrator of the plan. The subscriber/administrator contracts with a group plan provider, such as an insurer, in order to offer a plan to employees. The employees participate in the subscriber's plan to accumulate savings for retirement. Participation by the employee may be mandatory or optional. A group plan satisfies a very distinct objective for each of its two participants. An employer uses a plan, perhaps together with other company benefits, to attract and retain employees. A potential employee sees the group plan as a point of differentiation when weighing up a salary plus benefits package offered by the employer during hiring. Then, as an employee, the plan is a way to save money for retirement. There are 6 fundamental types of group savings plans, and their features and characteristics are described later in this manual. 1.3.12.1 Advantages and disadvantages of group plans. The advantages or disadvantages of a group plan depend on how well each type of plan available meets the objectives of the participants, and this depends partly on the type of plan adopted. These details are provided later in this manual. 1.3.12.2 Where and how to buy a group plan. Group plans are available from many providers. Insurance companies are one source. The group administrator coordinates a plan between the plan provider and plan members. The group administrator, black small square, enrolls new members, black small square removes those who are no longer employees, black small square ensures contributions are met, black small square processes withdrawal requests, black small square communicates plan details to members and management, black small square ensures each member receives an annual pension plan statement. Establishing a group plan requires the plan owner, which is usually an employer, to choose a type of plan that is suitable for its employees and the financial capacity of the firm. 1.3.12.3 Types of group plans. Group plans available for savings and investment purposes include the following: Defined Benefit Pension Plan, DBPP. A DBPP pays a specified pension at retirement to plan members. Defined Contribution Pension Plan, DCPP. A DCPP, also known as a money purchase plan, does not pay a specified pension at retirement to plan members. Group Registered Retirement Savings Plan, GRRSP. The sum available at retirement depends on earned income on which the RRSP contribution limit is based. Deferred Profit Sharing Plan, DPSP. A DPSP shares a portion of company profits earned by the employer with employees. Tax-Free Savings Account, TFSA. A TFSA allows an investor to earn tax-free investment income. The sum available depends on the amount saved and how it is invested. Pooled Registered Pension Plan, PRPP. 6. A PRPP is a retirement savings plan for small business employees and the self-employed, in which the sum available at retirement is not specified in advance. 1.3.12.4 Returns and guarantees of group plans. As a plan member, and perhaps an employer, make contributions to a group plan, that money is prudently invested so that, when the time comes, the member will receive the proceeds of his plan. Regardless of how invested contributions grow over the period they are in a plan, all withdrawals from registered plans are taxed as interest income. The only group pension plan that offers a guaranteed income on retirement is a DBPP. However, DBPPs can only guarantee the expected retirement income to members if their plans are fully funded. A fully funded plan is one in which the sponsor, example, employer, has made all the contributions to the plan for all plan members according to its actuarial obligation. Some employers have pension shortfalls because they have not made the required contributions. This means their pension liabilities are greater than their ability to pay. Pensioners could receive less than the amount of pension promised to them. 1.3.12.5 Risks in offering a group plan. The employer commits financially to make contributions and to pay the cost of administration. If business conditions change and company profitability suffers, meeting corporate commitments to pension contributions may be difficult. This could result in underfunded pension plans. 1.3.12.6 Risks in participating in a group plan. If a plan member, example, an employee, is responsible for making his own investment decisions, as he would in a DCPP or a GRRSP, then he faces the risks that come with investing, such as interest rate risk, inflation risk, and market risk. Also, the savings in a group plan are locked in until retirement. This means that withdrawals cannot be made before retirement. All provinces provide unlocking provisions in the event of financial hardship or other proven need, but the retiree must prove that the funds are needed. This is a good reason for an individual who is enrolled in a locked-in plan to also save in a plan that can provide immediate access to funds, such as an RRSP or a TFSA. 1.3.12.7 Plan Member Protection. Pensions are administered provincially/territorially through the Financial Institutions Commission or ministry responsible for the Pension Benefits Act of the jurisdiction. The rights and benefits of plan members are protected through the acts. Some safeguards exist against corporate insolvency and inability to meet pension promises through the agencies that administer pension legislation in their province or territory. However, there are companies that have failed to meet their pension obligation and have left their members with nothing. Their savings are gone. Some jurisdictions provide a guaranteed minimum income to plan beneficiaries who experience shortfalls due to underfunding. For example, in Ontario, the Pension Benefits Guarantee Fund insures pensions up to $1,500/month.7. 1.4 Risks of investing. There are many risks of investing. Some can be controlled by the individual investor and some cannot. 1.4.1 Economy as a whole. Economic risk, which also includes political and legal risk, is the possibility that an investment will be affected by macroeconomic factors. Such factors include a change in government regulation or political upheaval that intervenes in all aspects of a society. Pandemic risk must be considered part of economic risk due to the societal impact caused by disease and its aftermath. As 2020 proved, the global economy may be affected by a pandemic. Economic risk cannot be managed by an individual investor. It is very difficult to predict and can have a significant impact on investment returns. 1.4.2 Equity risk. Anyone who invests in stocks listed on the stock market, directly or indirectly through equity funds, faces equity risk. Stock prices are established in the market and represented by stock trading exchanges such as the S&P/TSX Composite Index. The market price of all stocks is in a constant state of flux, rising and falling according to supply and demand. Equity risk is the risk of loss because the stock price falls. 1.4.3 Inflation risk. Inflation risk is also known as purchasing power risk. Inflation is the increase in the cost of goods and services as measured by the Consumer Price Index, CPI. It is very important for an agent to bear inflation risk in mind in recommendations, especially when dealing with younger clients who rightfully anticipate many years before retirement or their death. The longer the time horizon for investing, the greater the impact of inflation. Inflation is one of the factors in calculating the real return of an investment. Investment returns become more accurate when inflation is factored in. Some investments' rate of return is lower than the rate of inflation. When this happens, the investor experiences a loss of purchasing power. That means he must spend more to buy an equal amount of goods and services in the future. Prices have increased but his income is less than the cost of the goods he needs to buy. The investor must face some hard decisions that can include taking out larger withdrawals, and thereby depleting his account faster than anticipated, finding a less expensive alternative, buying less, or going without. Inflation is made more serious because it compounds year over year. Prices are inflated on inflated prices and so on. This is why long-term investments with low returns are particularly vulnerable to inflation risk. Investments with low returns or returns that are tied to a specified rate of interest are most affected by inflation. These include investments such as cash and savings accounts, GICs, bonds, and money market funds. Segregated funds that experience inflation risk are money market funds, and those invested in bonds. Annuities also experience inflation risk when they are issued with a low interest rate. 1.4.4 Interest rate risk. Interest rate risk is experienced when an investment is locked in at a low interest rate. The investor will not be able to take advantage of higher interest rates if interest rates begin to climb. Interest rate risk is experienced with inflation risk. Versa. Therefore, the market value of a bond is less in a rising interest rate environment. Interest rate risk is inherent in all investments that pay fixed rates of interest. This includes GICs, accumulation annuities, payout annuities, savings accounts, and bonds. Segregated Funds and Annuities Chapter 1, Investment and Savings 48. 1.4.5 Market Risk. Market risk is the risk that the total financial market will decline due to uncontrollable events. Diversification does not provide protection against market risk since many or all asset classes could be negatively affected. Events that can precipitate market risk include an economic event or a recession, pandemic, a major natural disaster, or a terrorist attack. Liquidity risk is the risk that an investment cannot be easily and quickly converted into cash. It also describes the risk that an investment cannot be sold without affecting its value. Real estate is a prime example of an asset with liquidity risk. Annuities also have liquidity risk. Some annuities can be surrendered, but a withdrawal penalty charged by the insurance company along with market value adjustments will reduce the value of the investment. 1.4.7 Foreign exchange risk. Foreign exchange risk, also known as currency risk, is the risk that there is a change in price of one currency against another. It is experienced by investors or companies that invest or have assets or business operations in foreign countries. Investment funds that invest in specific foreign geographic locations, such as the U.S., face this form of risk. 1.4.8 Credit risk. Credit risk, also known as default risk, is the risk that a borrower will fail to repay a loan or other financial obligation. It is particularly relevant to corporate bond issuers. Borrowers with the highest credit quality, such as the Government of Canada, have low credit risk. When credit quality is low, as is the case for low-rated bonds, credit risk is very high. Low credit risk equals high credit quality, desirable. High credit risk equals low credit quality, undesirable. Credit quality is rated by firms including Moody's and Standard & Poor's. They provide bond ratings and ratings for many other investments and financial institutions. Insurance companies that offer exceptional financial security receive a top rating, such as AAA. Insurance companies rated C are the lowest rated class and can be regarded as having extremely poor prospects of offering financial security. Segregated Funds and Annuities Chapter 1, Investment and Savings 50. 1.4.9 Industry risk. Industry risk is the risk faced by specific industries, such as technology or mining. For example, the retail industry could experience consumer indifference to products, an inability to control costs, or a disruption among suppliers. Investments that experience industry risk include those that focus on specific industry investing, such as mutual funds. January 4, 10 Other investing risks. There are many investing risks, both general and specific. Agents and investors must be knowledgeable about the risks associated with investments to determine if such risks are within investor risk tolerance and risk capacity. Chapter 2 Segregated Funds. Competency component Black small square Analyze the available products that meet the client's needs. Black small square Implement a recommendation adapted to the client's needs and situation. Competency subcomponents Black small square Analyze the types of investments that can constitute a segregated fund and that meet the client's needs. Black small square Analyze the advantages and limitations of segregated funds in comparison to other types of investments in regard to the client's needs. Black small square Propose a recommendation adapted to the client's needs and situation. Segregated Funds and Annuities Chapter 2, Segregated Funds 52.